Hello, this is Pat O'Mara, and I'm pleased to have you join us here at Invenium as we talk about optimizing real world assets for institutional adoption. I'm here with Albert, who runs our AI, and Carrie Rudy, one of our two co presidents, who leads all of our market facing activities. And we're here with our good friend David Wagner from Houlihan Lokey. And I'm Pat O'Mara, I'm the chairman and CEO of Invenium. And David, let's start with you as a quick introduction. Give everybody a quick intro on Houlihan Lokey, what that is, the role that you play in dealing with real world assets.
Sure. So let me do the big picture first. Houlihan Lokey, a very large publicly traded investment bank. Um, we we are specialists in private markets. So we don't spend much time in public markets. We don't trade or build inventory. What we do is connect buyers and sellers in private market assets, value them, advise how to diligence them, advise companies how to prepare to borrow in those private markets and how to execute those capital market transactions in a private arena. And what that means is that we talk extensively to LPs and GPs, and and the conversations have evolved over that last 10 years, such that people are asking questions now about how do I scale up? How do I get a digital construct in my operating system? How do I become more efficient around my operations? And how do all of these things create more opportunity for me as a manager, a GP, and then for my investors in terms of things like liquidity? And all of those issues are the ones that our bankers deal with day to day. In the advisory business that I sit in, I specialize in valuation of these assets, and that valuation incorporates all of these concepts of liquidity and information access. So we sit right in the middle then of this private market asset creation and trading structure that needs a better solution.
And and when you talk about needing a better solution, why does it need a better solution? Is it that the returns aren't good enough? What is it? The liquidity? Is it the data is bad? Is it market size is incorrect, meaning only a small percentage? Why does it need this transformation?
So it feels right now that that's sort of it's one of the biggest questions. It's one of the questions the bankers in my firm ask me, but it's also a question they're asking themselves and their clients, because I think from the client driver, clients recognize that there is a huge amount of money available to invest in private market assets, which is not being invested. So, as a very straightforward commercial business opportunity, these managers see AUM growth as potentially much larger, but they recognize at the same time that their operations, as well as client operations, and as well as investor visibility, are all starting to become gating issues. It's not a small environment anymore where people are sort of club dealing amongst themselves. It's a much larger environment, and they won't be able to scale and create these commercial opportunities for themselves without that environment. So it starts, I think, as the biggest motivation is the GPs who want to scale, increase AUM and fees proportionally.
And I think that that's 100% accurate. And as we talk about institutional adoption, that's also true. But on the other side, there's an enormous amount of trapped value
Yes.
in private market assets, right? That needs to be unlocked. And when we talk about real estate, when we talk about infrastructure, right, and we talk about private credit, the ability to to generate turns on those assets so that people can get out and reallocate, but also others can get in, and they get in knowing that they can get back out because they don't want to get somebody else out. They're out, then they're stuck. Does that make, you know what I mean? And so this it really is a lot about also expanding the size. The market itself has huge amount of cash sitting on the sideline waiting to go into assets that need to be ready for those institutional buyers. But also, that that's half the equation. You flip that coin over, it's all this untapped wealth that wants to get liquid. Does that make sense? And then reallocate.
It makes perfect sense. There's wealth that wants access to alternatives and is not comfortable with the way it's either presented or transacted or handled, and that's a limiting factor on that side. There are also entire asset markets, and real estate's an obvious one, where for years things like the commercial-backed mortgages tried to create investing streams and lending streams into these assets, but there's a huge amount of assets that haven't benefited from all of the cash that's available, and all of those are they need some data for people to look at and understand how they affect portfolios. But one of the things that private markets do is they continue to diversify. They continue to give people this sort of increase in Sharpe ratio returns, and they want to do it. So that's probably motivator number two, right? First it's AUM fees, and then it's increasing the diversity in these portfolios and their commensurate risk-adjusted returns.
And for many of these private market assets that need to become private market portfolios, that need to become products that need to be distributed, right? We go all the way back to the underlying asset. The administration of that is not just kind of the very end point of how do we get this product and make it digital so we can move it in whatever form, but it's really the administration from the asset to the portfolio to that product to distribution and really going digital from end to end, right? And there's different players in there. And Albert, I'm going to go to you, right? When we think about this movement of trapped value in a real asset, understanding that asset, bringing that digital, moving that through the administration, and as I think about it, right, like I would just say, whatever this is asset administration, this is fund administration, this is registry, this is treasury, it is automated functionality around calculation. So think software, as well as interaction with the UI, UX, and then the data and analytics that are repricing and it's administering on the frequency that people want to buy, meaning daily, weekly, monthly, whatever that denomination is where you want to provide liquidity. That administration has to have that same cycle. And if everything's manual, that doesn't work, right? How does that work into what we're doing in this whole movement of digital that is on top of or encompassing of tokenization as a very small part?
Wow. Pat, that's a heck of a big question. That's the great thing about these webinars is, you have a company that is paying McKinsey probably $500,000 just to answer that question. They're going to get a 100-page report. They should have just watched our podcast episodes. Could have gotten the short answer. Look, the fact of the matter is that the market as it exists has a huge number of inefficiencies, and that introduces an enormous cost on the system, an extra cost that doesn't need to exist for each of those inefficiencies. And who pays that cost? The short answer is everybody. Everyone involved in the system pays that cost. And usually these inefficiencies take the form of a delay between when you could know the information and when you actually do know the information. And the biggest enemy is the clock, right? And the thing is that these inefficiencies essentially exclude or prohibit a huge amount of participation in the market. As a result of how slow things need to move and how cumbersome they are, you have minimum investment thresholds. You have a certain amount that's just, table stakes to even get involved. You have a whole bunch of intermediaries. You have auditors, you have brokers, you have all that. Automation is changing the game in the financial markets tremendously. And it's changing it from the state of the art being manual and Excel and spreadsheets and emails and copies into data streams, a data feed, just like you see a stock ticker. And that concept is really hard to imagine in the context of private market assets in particular. But I think that is the ultimate dream of tokenization, is to trade private market assets and real world assets the same way that you trade anything else.
Yeah, and I want to say, I think tokenization, I'm gonna maybe push on two of the things that you just said. Tokenization at this point, right? We've been arguing what tokenization is since 2016, right? Or I've been in that. Others before were calling it color coins and 15, et cetera. But what is tokenization? And right now, tokenization, for particularly as you think about real world assets, it doesn't necessarily mean blockchain. It means digitization in a lot of people's mind. Do you know what I mean? And yet they then, when they do that, they veer towards centralization, which causes bottlenecks, et cetera, instead of this decentralization and a networked reality. And Carrie, I want to take this to you. Albert, one of the things that you said was, the enemy is the clock. That is for broader market adoption. That is the truth. But for a lot of GPs, the clock is their friend, because they know the information immediately and they're arbing it to the benefit of their LPs. And what they don't want is broader market adoption of these mechanisms that digitize so that everybody has the data at the same time. You know what I mean? Because right now, just early knowledge, you can have a competitive advantage from early knowledge of the state of the market. Soon, when the whole market knows everything all the time, you're going to also have to be an excellent operator and be a value adder. You know what I mean? To this, in addition to just early knowledge. And Carrie, this is going to be disruptive of some institutions. So some institutions want this, some are fighting it, right? And what is that balance? Who's fighting it and who wants it?
Well, I want to push back just a tiny little bit on the part of the GPs. Yes, they like the information asymmetry, but they have their own problems just getting a handle on their own data. So the first step really is, how can they get access to their portfolio company assets and data much more efficiently? And so when I think of tokenization, I think of that as the end product. I actually think of digitization of the data as an interim step before you get to tokenization, where GPs can actually digitize all of the information that they're getting from their portfolio companies and their borrowers with private credits, just to be able to organize the data and be able to make decisions internally faster. Now, they're not going to want to share that information with others, because then they can even arbit more. So that's kind of the first step. And I would say that almost all GPs want to digitize their data. And what maybe they understand or don't understand is that by digitizing their data, they're preparing themselves for tokenization. And I think that, this balance between information, having access to information, and then what the market wants, the LPs obviously want information. And when there's more and more adoption and digitization of the data, at some point, the tide's going to turn, and they're just going to have to be able to offer that up to LPs in order to be competitive with other GPs. As soon as that threshold is reached, I think it's going to be a tsunami, and all the GPs are going to have to start offering more transparency to all constituents. And like you said, then they'll have to distinguish themselves by being a better operator.
And what that transparency is, they're gonna be forced to be offering this transparency. What does that look like? Is that third party marks? Is that direct underlying asset portfolio performance? What is that going to look like? And then what is that going to foster? Meaning third party marks, better data streams, correlation, comp sets. What's that going to yield?
Well, the end game is that it yields greater liquidity, and greater liquidity is going to reduce the discount relative to public securities. I mean, that's the end game, right? That's going to increase the entire value of the portfolio that they manage and be able to offer in the long run higher returns to their customers.
Yeah, and David, I wanna really turn this and bring this back to you, right? When we're thinking about this, and the title is real world assets, getting them ready or optimizing them for institutional adoption. But we also need to be aware, right? Real world assets in the DeFi and crypto world means tokenized treasuries, right?
Yeah.
In the DeFi world. But that's not really what we're talking about, right? And in our comments, we already have people talking about real estate and real world assets. And for us, we're talking about alts, right? Private markets, meaning real estate, private credit, private equity, infrastructure, right? And David, I think that's a little bit of what you're talking about, right?
Yeah, that's exactly right. Let me talk a little for a second about a project that we recently worked on, because it is real world assets. In fact, it's very real because it is dirt in the ground. So we helped a company take dirt in the ground, or let's call it valuable minerals in the ground, and convert it into a representation, which is a token, and that token representation allows that company to borrow against their assets much more easily than if they had to borrow against the dirt in the ground in a conventional way. So what that creates for that company is a financing solution that removes just a whole bunch of friction around how do they get a loan to to buy equipment to dig, to buy additional mineral rights and for the next part of their operation. So companies are looking at this and saying, all right, I can use this tokenized structure as a financing alternative in my capital stack. But the interesting thing for us was that when they brought that security and they chose to have it to represent that token as a security and have an offering document associated with it, that offering document brought a bunch of interesting problems. The language of the offering document didn't look either like credit or equity. It looked sort of like an asset securitization, and had elements of other things. So we really had to go through sort of fundamentals of a capital structure and rights, and how do those things get represented, where for the most part, and particularly in public markets, you say equity, it means something. It means that that ownership of all residuals and of liabilities and assets in the company. Well, in this tokenized format, it looked a little like equity, but didn't have voting rights. So it had certain defined rights and then some things that you might have taken for granted that weren't in there. And when we talk about preparing a real world asset for markets so institutional investors can start to look at it, we also need to think about how that sort of that traditional ownership of either a liability in the capital stack or the equity gets represented in that token. And the reason I focus on that is because that's going to require investors to think a little bit differently about characteristics of those tokens, which don't necessarily align with public markets. And all of that is going to require a deep understanding of exactly what does that thing own, what are its underlying performance characteristics, what's that, how many ounces of mineral rights do they have in the ground. And so in order to look at this offering document and understand it well as an investor, you need to be able to click through, if you want that metaphor, click through this and really understand exactly what is it that you're being granted, because tokenization doesn't always conform to our traditional capital stack, asset-backed or equity characteristics.
And what in here there's a key, which is tokenization can't be synonymous with poorly structured, right? And if it is something that is asynchronous or outside the norm of what people are used to seeing, in addition to the fact that the ledger is distributed and it's digital and I now custody it in a new place, I also have to think about how I think about it from a risk perspective. Man, that's a lot of new things to think about. You know what I mean? And we've got to think about how do we structure this thing. But I remember, in the 90s when I was getting pitches for growth at a reasonable price as a new thing. You know what I mean? And let me tell you what GARP is, and we fit right in between value and growth, and this is why GARP. And every time somebody comes up and they say, "Hey, my little 4 box," right? I remember, in the early 90s, right, on the asset management, we had the 4 box, and then it went to the 9 box, right? And then, I don't know if you remember this, and then there was a 16 box, and then they started making it a square, and they began elongating it about what you needed to own and that allocation. And when I, was CIO of a university, and we were looking with Nakuba, literally what we would submit against all the other universities as far as how we were allocated, it was across a whole ton of stuff. And as we did this and we were looking at all these different pieces, people need to be able to say, I'm buying something in digital form, but it needs to relate to something that I understand and know, right? I got to be able to correlate it into this thing. And tokenization is the new way that I'm going to deliver this digital instrument. But this gets to the whole piece of what does institutional adoption mean, right? And there's going to be 2 sides of this. One side is DeFi is going to grow, and it's going to create new things of early adopters that the institutions are going to come second. But then there's another form where institutions were saying we're conforming the assets into boxes that they already have and they're ready to put money into. Does that make sense? And I literally think that when we think about optimizing real world assets for institutional adoption, there's a DeFi growing that till it's so big institutions can't ignore it. And then the other thing is, how do we deliver this efficiency in the administration and the pricing and let the incumbents grow their market cap, their part of the market, how quickly they can deliver to their clients. Go ahead, David.
So, well, I might say it a slightly different way. And Albert, this one's for you. If I'm a traditional asset manager, like Pat's talking about, I'd look and say, hey, the world got much smarter. Why do I have to figure out this new thing? Why can't you make this new thing fit into my framework, right? You're the smart guys. You've got all kinds of computing power. Make this new thing fit into what I already know. And that's kind of the question. How can we make that happen?
Yeah, it's a great question. It's a question we have to answer over and over again every single day. The thing is, it's an arms race, right? So that's the reality of it. A lot of companies have extremely valuable data that they receive every day, and it takes X amount of time to get incorporated into their operations, if it gets incorporated at all. You have companies spending millions of dollars, have entire research divisions to produce, correct reports on the state of whatever industry or market. And then they spend approximately $0 on making sure that those reports actually get to the people that need it based on their current portfolio or trading strategy or whatever, or areas of responsibility, nothing. So you have these huge inefficiencies. And I've long since learned not to try to fight the fight about transparency and getting GPs to be more transparent to LPs. I think I could begin and end an entire career just on that soapbox alone. But even if you don't want to do that, at least be more transparent with yourself. At least be honest with yourself about what you are dealing with, what insights you have in the data. And the fact of the matter is that if it's sitting in an Excel document on some intern's laptop on the beach, and it's not being fed into the larger data stream that the company is using, it's not valuable and it's useless. And all you're doing is delaying finding out the truth. And that has a cost, whether or not you have to bear it in the short term or not. Someday, as these efficiencies continue, and I think the future is coming for us all faster than we'd like to think. The truth is that getting that data to be useful faster is the arms race that everyone's fighting currently.
And I want to say this is chapter 70 in a 1,000-chapter book, right? Meaning we've seen this chapter, we've seen this play out again and again and again, right? When they did away with brokerage commissions, right? I use these examples all the time, right? And all of a sudden trading started to go. The majority of the firms that died in the beginning were not the ones who were willing to conform. It's those who couldn't maintain the back office with the increased throughput, and they couldn't clear and settle their books. And the New York Fed literally started taking all these different things and giving them to Pierce, Fenner, and Smith, right? And then they start giving them to, I forget what Citibank's precursor, entity was, but they started literally giving them.
Norman.
They started literally consolidating these because their books wouldn't reconcile and they couldn't maintain. We have private credit funds that have been amazing at raising money, and they've been deploying it maybe equally as well. Their risk book is not great, and the first market shock, a bunch of them are going to consolidate into those that have risk systems that are fully up to date, but most of them don't have anything even close to what the old dinosaur bank risk systems looked like. Do you know what I mean? Forget state-of-the-art cutting edge, right? And literally, and the reason that they don't have them is nobody's making them have them. Does that make sense? And literally, they could just create this, and this is part of the infrastructure, the next generation of alternative infrastructure that the first market shock is going to cause some serious consolidation. But Albert, as the future is coming to people, when it arrives, it's not it's going to be there, and if you're not ready, you're dead, right? You are dead.
Yeah, and the interesting thing right now is you have all these tech companies, AI companies, who have these incredible powerful supercomputers and AI tools, and they want to use them, and the financial firms want to use them, and then the financial firms get to the AI companies and they say, hey, we want to use your tools to make our business better, and the AI companies say, great, give us a copy of all your data, and they tell them to go take a hike, because even if they knew where all their data was or what all their data was, they're certainly not handing over a copy of it. So I think I'm on a slightly different page than Pat and Carrie, I guess because I'm not wearing the same t-shirt. I didn't get the memo. But we talk about automation and digitization as important steps, but there is one step before that: formalization. You actually have to know what all your steps are and what all your data is before you digitize it and then automate it. And that's really the key. If you're running an oil refinery, yes, you need a factory. Yes, you need a pipeline. Yes, you need customers and whatever. But first, you need a goal of what am I refining crude oil into in the first place? And that's what a lot of I think adopters of this stuff are missing, is how does my data process even work? All they know is I get this thing, and then I do steps A, B, C, and D, and then this thing gets handed off to this guy. And there's virtually no one that has A to Z view of all the steps from beginning to end.
I was talking to a European bank the other day, and that we're looking at their risks management system, and they were doing a demo to us, and I was asking them, and I said, what, they get whatever, every time they get a document, they get 157 data points pulled out of that, fed into them, and they are looking at it. And I said, now when you want 158, what do you do? How do you get that? What's your mechanism to extract it? And what's the mechanism by which the data becomes actually, turned into structured data? And he said, oh, I just literally enter it into the system, and then the next cycle, it's all in there. And literally, there were magic work fairies that was transforming the data, right? That he, sitting in the portfolio, didn't know, didn't care, didn't understand the steps. But that's all being done manually behind the scenes, and that is an obstacle to scaling for those traditional players. You know what I mean? And this is, how do we give the data they want in the need in the form that they want and need, in a way that they can recognize, so they can buy it and sell it? Does that make sense? Because they'll do this much change, but this much change is too much. You know what I mean? And so if you say, here's a good opportunity, but you got to do this. Go ahead, David.
Well, what I'm thinking about is the difference between banks who have formalized, regulated risk systems versus asset managers in the private markets, who don't. They have risk systems, but they're not formalized and regulated, certainly. And those risk systems are sort of hand in glove with trying to create alpha. Right? It's a risk system, but it's really an alpha identification system. Which is very different than a bank, which asks, how do I get hurt, rather than how do I do well? What I think what's incumbent on us is to show that sort of these federated data systems can create both. How do I prevent myself from getting hurt, but how do I find some alpha if that's possible at the same time?
And those asset managers, as they literally are growing their capability and the data analytics that they have on this, and how do they use these new AI tools, and how do they trust the AI, and what's the context for it, and how do they use it efficiently with their data, everything that Albert does. As they're doing that, we also need to remember their customers, the big global allocators, the LPs, and also the mass affluent. They demand these things, and not just quarterly or annually. They're going to want to see it at that same cadence as the trading is available. So if I'm going to buy and sell, I can see that this administration and the data reporting is coming at that same cadence. Go ahead, David, you were going to say something?
No, it just one of the things when you talk about cadence, as a valuation shop, we see most of our fundamental change to an instrument quarterly. But there is an increasing need, and has been for a couple of years now, particularly with retailization of these private assets, for higher frequency, at least higher frequency marks and higher frequency analytics. And we don't have a good mechanism yet to find the correlated drivers of change of value in private assets. And part of the reason is that we can't stratify these assets well enough to look for those correlations. The data isn't in the right format or available enough across portfolios to do that. A risk system needs, to get the sort of real time you're looking for, it needs to say, well, I can't just have a feedback loop that says, an index changed, so my private changed. I need something a little bit more granular than that. What are the 4 factors that changed my daily or weekly mark? And then you can start to have a risk system that can forecast and look for those things. You don't have it yet because the data is not in the right form.
Well, and that data transformation, that enterprise data management, and that cross-enterprise data management that can be used to fill in these systems is also coming into an age where people are investing just shovelfuls of cash into inference and data centers and the ability to do compute, et cetera. There's only really 2 people in the whole world that we are aware of that are really doing this enterprise data management, Invenium and Google. And Google, it's an add-on to Google Cloud, and you got to move all your data to Google Cloud. But this enterprise data management, where you have got permissions and workflows for this infinitely large number of kind of ways in which you treat data according to this asset, according to this portfolio, according to your rights and responsibilities as an analyst, portfolio management, IC member, board member, whatever it is. And you say, I want to allocate, and what's the context of documents that I want this AI to run against without opening my kimono completely to some third party. And also I can plug and play different AI solutions. As we begin to do this, and we're going to start to see and correlate assets and get this better pricing.
Well, you talk about permissioning, and permissioning is right. It's a little bit of a misunderstood topic. A lot of permissioning allegory goes with, can you see the document or not see the document? And I think, and Albert, I know that you have started to work on how to do this, but the question is, how can I permission the stack of data that comes out of that document? That's way more interesting, because then whether it's internal or across investors, you can permission I'll think of it as granularity, but you can permission from a high level to a very granular level the kinds of information that comes out of documents, and compare across documents, because you don't have enough specific identification. So looking at that more like a matrix of permissions is really powerful. And that gives everybody a view of the market without violating what disclosure and privacy.
And David, I want to push back on something you said. You said Albert's working on that. We're literally kicking off version 3.0. Version 1 took 2 to 3 years. Version 2 took 2 years. Version 2 is launched, live, and ready. And right now, one of the things, when you said Albert's working on that, he's working on version 3.0 of enterprise and cross-enterprise permissioning systems as it relates to roles, functions, tasks, right? And then content, permissioning according to content. Most of the limited partnership agreements and the regs don't relate to content level, it relates to document level. Does that make sense?
Makes
I made an
perfect sense
obligation
to me.
to
But
share
I
that.
think that's one of the arguments for the SEC is to say you have a way of permissioning content, so you need to rethink what disclosure means.
Yeah, and
That's what they think today.
Yeah,
a year and a half from now, they're going to think the opposite.
Yeah.
In a briefing they file. So,
and I think one of the reasons that the private markets can leapfrog the public markets is because the market itself can adopt a standard ahead of regulation, because it is a less regulated, because it is a buyer beware market, because it is, a big boys market,
and
right?
It's decentralized, Pat. You got to have a mechanism to be able to see the data where it is. Just if you bring this to a practical use case, if you're managing a closed-end equity real estate fund with 40 office buildings in it, having a system that can literally go into Yardi or MRI or wherever all the leases and rent rolls are, and can literally check the folders on a daily basis and see what changes from day to day. And then you can set up rules and say, if the number of lease expirations exceeds X% for a particular property, this may trigger a change in value, and you have to go check some other market parameters to see. So that then you can begin to automate and to understand if there's enough changing in the portfolio on a daily basis that could affect value.
That's exactly right, Kerry. And I think that the hurdle that everybody's hung up with is everyone's whale hunting. Everyone's trying to build the perfect investment model that's a one size fits all, and the perfect AI that knows everything. It's kind of like, I'm going to build the perfect golf club, the one perfect golf club that I could just use all the time for everything. And that's just not how the real world works, because you have different things that you need in different situations. And when you have one AI model that tries to get very, very precise, the problem is a lot of the alpha that's created is in the chasm between 98% accurate and 100% accurate. Okay, you're up to speed. You're 98%. Now that's your first day on the job. Now the actual work begins. And the thing is, if you allow just a one size fits all model with all the compute and all the data, you have one client's data, their priorities and goals, taking it this way. And then you have the other one taking it this way. And you never quite get to that localized, correct answer in the right situation at the right time.
I love your comment, Albert. I think back, and I use this example all the time, right? Charles Babbage and the universal calculating machine, right, which was going to solve all calculations going forward, and which is great, right? And they carved it out of wood. Like, that's amazing, right? That they created that in the 1800s. But the point is, this is not, and I need to withdraw that they carved it out of wood. I'm thinking because I've seen it, but maybe not. You're right. I withdraw that. But it was a mechanical turn. It wasn't an electronic turn. And with that being said, you look at this and you say, we need to have specialized functionality to administer unique actions on unique assets with individuals who have permission to see this. And there's some real customization to that. And when we look at this and we deliver that value where people understand an asset better, real time, the market's going to move. And I want to bring up this maybe next topic set to all three of you. I was having a conversation with someone who was talking about, with real world assets coming, the only way to start is on primary distribution, right? Because we got to build this, and I view that fundamentally as a wrong idea. There are so many assets that are already in the market that somebody's looking for a secondary on. You know what I mean? And I was looking, I went back and I checked on some stats. Evercore, they size this at $435 billion of secondaries just on private equities and privates, and 285 billion is what they brokered. You look at that and you just go, man, if there was good data sets on that, because the building the digitally native, it's going to take a long time for enough inventory for there to be a real market. But if we can give the data and convert something that's been in existence in the marketplace for a long time, start to create some secondary liquidity around that, the primary is going to drive into that secondary, which is being created of what's already in the marketplace. And I want to open this up. What's going to come first, the secondary of what's already existing, or is it going to be the primary? Kerry, you go first.
Yeah, I mean, I think what's happening is that the DeFi community is working with either the very low end of the institutional or maybe the family office market and bringing that into the DeFi ecosystem on a primary basis today just to get started. And they're kind of testing the pipes and making sure everything works and delivering the value. So I think that actually is happening right now. And I think it's going to bleed over into the institutional market. All the GPs care about, its distribution. So they're probably going to start there. But once everybody begins to get comfortable with all the infrastructure needed in order to make sure this stuff works and works accurately, the entire secondary market's going to open up, I believe. So I think that'll actually happen after both sides have some adoption and get comfortable. It's just my opinion.
And I really believe it's the railroad going from the East Coast to the railroad going from the West Coast, and we got to figure out and make a way that they meet in the middle, right? Not instead of not two states apart. David.
Well, yeah, so there's a sort of a fear and greed story here. The investors, LPs want some liquidity. GPs recognize that they're not getting IPO exits, right? So the cash isn't coming back the way it should. Right? These are real issues that are driving the secondary market for LP interests. The fundamental problem with it, though, is when you go to sell a piece, that price informs the whole fund.
Yeah.
And that scares people. So that's the fear part. Nobody wants an off-market price informing their entire fund and their entire fund's performance. So they're happy to have privately brokered arrangements where they can slowly and carefully get price discovery and make sure that execution is within whatever everybody's parameters are. The idea that you've got a bunch of people who are clicking through underlyings and making their own determination of value for that fractional piece, that definitely scares GPs. And that's the only reason why I would say secondaries will be slow. I think nominally it's a great place for this kind of information access to drive liquidity, but I think there's some fear around what those ultimate prices are going to be and how it informs the rest of the fund.
Yeah, and I think that this really gets to where is the value, and this comes the conversation full circle. Where is the value in privates to go digital and for tokenization, right? And real world assets coming for institutional adoption. And I really want to kind of hit on that again and again. I think people talk about liquidity. They talk about secondary markets, the ability to get more people in because those people know they can get out. Do you know what I mean? The check sizes go up, the number of people who come in go more. But if you have more people coming in, the administration is a nightmare. And without automation, that begins to break down. And with automation, if you don't have attribution and context for the data, the automation tools don't work. And we got to have trust in that. And this is where blockchain adds its value to AI and RPA and ML, right?
Describe that, Pat, what that literally means, attribution. I mean, it sounds simple, but when you create that link from the extracted data back to the source document, that's attribution. And when that piece of data that came out of that source document travels into a spreadsheet or some other application, and that user of that data, whatever application they're using, can click on that data point and pull up the source document, that's attribution.
It is. And before attribution, that automation tool needs context in order to work. Yep. And how does blockchain create those rails? Albert, I'm going to let you hit context, right? I'm going to hit attribution, and then let's go to trust, and I'm going to actually throw it to David on that. But what does context mean, and how does blockchain provide context just to AI as an example?
So this is actually, I'm going to have a bone to pick with the whole industry, really all our competitors, and our competitors are all kind of grouped into one category, right? It's all back to the data. I'm going to pound on this again. I'm going to broken record for a second. This idea of a data lake approach, throw all the data together, one giant database, create a standard format, wedge it all in there, and then you have nice homogenized data, and you can do whatever you want with it. It's a fundamentally flawed approach because data comes from different places. It should be evaluated differently when it comes from different sources. The metadata of where that data came from, how it was handled, what occurs on those sources, all of that is tremendously valuable. A very common use case is, what's the correct version of this document? Is it the most recent? Is it the one that was approved, by this person last? Is it the one that was certified by the auditor? This and that. It could be any of those. And without some schema of understanding how all that metadata relates to the veracity, accuracy, and therefore, persuasiveness of different pieces of data, because they're not all the same. Without maintaining that, it's just a fundamentally flawed approach to throw it all together and throw the baby out with the bathwater, just because it's a little hard to deal with several different databases that are handled a little differently. So let me just, put away the soapbox for a second. But context means more than just what are the words around the field that I want, more than just the labels on the chart. It's what source data was used here, how was it collected, how often is this accurate, what is the track record of accuracy, how different is this version from the previous version before it. All this metadata, which is publicly available on a blockchain when you hash the values of files to the blockchain over time, and the AI can actually use that to determine and inform a query. All of those things, besides the fact that AI can't cheat it, all that stuff really has a tremendous impact on context, besides just what we talked about earlier, provisioning an AI model for a specific client only and not trying to take the one size fits all approach.
And literally forcing AI, which is a machine which is going to do what it's told, and if it's not given enough instructions, it's going to give you bad answers. It's going to make things up. But literally, the machines do not lie. They do what they're told. And if they're not given enough instruction or clear instruction, they make things up, right? And the things that they make up is, Rudyard Kipling's wonderful poem, The Machine, right? Where he talks about the machine does not lie. We have built it. It will produce exactly as what we've told it. And what it is we do is to say, if you don't know, deliver an answer, even if you don't know. Well, if we can create the context and say, you must find the answer within these documents, you know what I mean? And only these documents, and create guardrails and constraints. And the AI begins to look at that. But then also we could say, this is the most recent version, but here's the one before it, and the one before it, and one before it. And all of a sudden we begin to make that data available for the machine to do its work. That context allows the machine to find the right information, the AI library, et cetera. And then you immediately run a second one, right? We get Claude to do it first, then we do ChatGPT. They double check each other. That throws out a solution, and that's delivered to the human, and the human then can double click and read it with their own eyes. And the real intelligence can say, yep, the artificial intelligence saved me a bunch of time, or no, this doesn't look right, I'm gonna have to dig in. Does that make sense? But literally that speed of what artificial intelligence can deliver to a real intelligence, who's then gonna validate, and then it's gonna go through a process. And this literally, that cycle is gonna go at a tremendous pace, but that real intelligence needed the attribution of the ability to double click. And this eventually is going to get to the investor market, where one investor is going to double click and say, I don't believe that number, so I'm shorting, or I do believe that number, so I'm going to go long, right? Or this trend makes me think this, or this trend makes me think that. And this is the value of a two-way market. And some are going to go long, some are going to go short. People are going in and out of markets, but they're seeing and evaluating data with source documentation. And then what happens is, if there's no trust, as you said, Albert, in the ability to understand the source of the data, the veracity of the data, the reliability of the data, right? And you just got to trust the machine. Well, then what happens is all the money gets funneled to a few little names. Does that make sense? And that's what some of these big names have been doing, saying, trust us with your money, and we're going to go into these systems where there's really bad data. As the data becomes perfected, the markets are going to expand. There's going to be wonderful things happening. And I know we're getting off on a soapbox, but that is context. That is attribution. That creates trust in data. And if it's digital and it's being administered And David, this is what we've been talking about, right? You've been doing this in your career for 30 years, where you've been bringing digital to new markets, and again and again and again, when that's happened, what are the consequences?
Winners and losers. That's the best. That's the best part about the market. Winners and losers. I was thinking earlier as you were talking, efficiency and cost savings create winners and losers, but increasing liquidity and along with it, lendability and leverage, that makes the pie bigger. So I look at these two different directions.
Really good.
And where I've seen winning that happens out of this is where you create liquidity in markets, more participants, bigger pie, and sometimes the liquidity goes hand in hand with efficiency. You're going to weed out the expensive people, the inefficient people, whatever that provider set is, the middlemen, but you are going to create a market that allows individual investors to choose their. I mean, private asset markets are amazing when you think about them versus public markets because they sound like a long-only manager from 1972. I buy things, right? I buy things. Sometimes I never sell things, and I just open up a new fund and I buy more things. So they sound like a long-only manager, where public markets know that the ability to short and the ability to change the leverage ratio that you're using in your investment strategy is a huge differentiator. It's a huge way to create alpha. And private markets don't have that. They don't have it because they're structurally flawed in terms of their data. But that's where the market gets big. This is where the pie expands when you have all of this. So efficiency will drive it, but liquidity and an expanding pie, because you get lendability, you get shortability. That's where this really gets important to investors and GPs.
And I want to hit that point really, really tightly for 1 second. Let's stay on that. So first off, the ability to grow the pie, fabulous comment, right? Winners and losers are off the costs and efficiencies, but the ability to grow the pie is where you create a lot of big winners. But in the private markets, Schiller created the concept of a perpetual contract in order to not trade the underlying, yet still have a mechanism to expand your participation in multiple buildings, right? And those perpetual contracts that you cash settle give you the ability to not only, without exchanging the underlying, the tax consequences and all of those that is very long and messy for big assets, but where you can say, I now have diversification of performance, right, across multiple cities as we've created this cash settled perpetual contracts. That's what crypto took and ran with and incarnated that needs to come back into real world assets, so somebody can say, I'm going to short Paris against London, right? Or I'm going to go long Miami and short San Francisco on CRE, et cetera. But we need indices, we need pairings, we need AMM, we need pricing. All of those things now exist, and we're bundling them together, where we can literally have a feed using something like Pith for what's on chain and using Invenium for what's out, that's off chain, that's private market data, that's going to feed an AMM, that's going to have these pairings. And this is what's going to allow these private markets to explode. And this gets the institutions really excited, because if they can have a mechanism to hedge a private market portfolio, the liquidity opportunities it creates are huge, right?
Yeah, let's just assume you're a major U.S. pension fund and you're invested billions in U.S. office space. You can't do anything about that today. If you had this commercial real estate derivatives market, you could literally hedge your position without having to go to the GP, without having to incur a huge discount to sell out of your position. So yeah, I think the demand for this is just enormous. The opportunity is tremendous, and this technology exists in the crypto derivative space. Pat, I'm not sure the total number, but it's in the scores of trillions of dollars that have been traded. Just imagine applying that technology to real estate, the multiples of the volume that would occur over the next few years.
Kerry, we're involved right now with building this and making sure we have the right regulatory structure and launching the world's first derivatives marketplace for alternatives. we're looking at, one of the better players, and they're talking about denominating. They have $1 billion of throughput a day on those types of pairings, right? $500 million, but it's in that denomination, $1.5 billion in that range. In the fixed, interest rate derivatives are 5.2 trillion a day, right? And all of a sudden you just go, wow, if real estate can really hedge at scale, it's going to dwarf that number, right? It's going to dwarf that number. Absolutely. And all of a sudden we're opening the door to the ability to expand the market, right? David, as you said, unlock the value, let the money flow, and the money capital that's locked is dead, right? And and I'm not turning this into a religious entity, but I think there's a story in the Bible about the guy who gets the gold and he buries it. Do you know what I mean? And it's locked and it doesn't yield anything, right? And the reality is, people who are stewards of these assets, they, that through generations or through corporations or through endowments or whatever it is, they want to maximize value. They have an obligation from a stewardship perspective, and the more we can bring the ability to unlock it and reallocate appropriately, it creates huge opportunities.
And they have to do it. They have to do it without risk, Pat, or not without risk, but with understanding the risk, and that is where the data comes from, because they're scared right now. They can't do that commensurate with the risk standard that it requires.
I love that Tom threw up the shout out on the bottom. Thank you, Tom. David, I want to give you the comment or the last comment. Or we're going to go around last comments from you.
The quick one is that if prescient and forward-looking private asset managers know that the pie can expand in the ways that we've talked about, and they know that private asset markets have to turn into something that looks and feels and operates like a public market, but is not a public market. And that difference is what it's going to take all of us to think about and create. But the commercial motivation for that to happen amongst particularly the largest, most sophisticated GPs is absolutely out there, but they want to do it without cannibalizing. So we just have that's the road.
Kerry.
Yeah, I just want to say that in order to get to that future of liquid state and private markets, it all begins with digitizing your data on a decentralized basis, really, to be able to have the right architecture to get the data from the assets ready to go. And that's where we're focused.
Awesome. Albert.
Yeah, so I think my opinion on this is that a mature market is only as good as the information that's available within it, how much you can trust that information, both in terms of people's willingness to participate in it and the efficiency with which it operates. And, the future is when there are multiple AIs for all kinds of different parties interacting with each other. And there's going to have to be a robust framework that keeps that under control in terms of data integrity. And, a uncontrolled, automated market like that isn't a mature financial market. It's a boxing match with no referee.
Yeah, Tom, if we can pull up this quote from Yonks.eth, that tokenized assets are worth more than assets that are not tokenized. That, I think, the case can be made if the administration of it is digital. So if the ledger is decentralized and it's a token, but there's manual administration of it, of all of the asset and the portfolio and the pricing, I don't know that it adds a lot, right? But if it's digitally administered, if the data is correct, auditable, and traceable, right, where there's full attribution, plus digital administration, plus a place for that token to live, it's unequivocal that better data, better administration unlocks costs, makes an asset more valuable, and then with a place for multiple people to understand that data in that cadence in which they want to buy and sell it, that asset is, undeniably more valuable. right? So, hey guys, it's been great to be with all of you. Thanks for being on here with us as we discuss optimizing real world assets for institutional adoption. David, always great to have you with us.
Very good. Thanks.